Okay, I think. Okay, looks like it's recording now. So this is a training on a seller buy down of the interest rate, and we're going to kind of give an example of. We can look at a permanent buy down, which I think is kind of. Or we can look at a permanent buy down and a temporary buy down. Okay, so just to kind of direct you to some resources that are available for this, and I'll attach this to the email I'm sending out. And let me share my screen. So I think this is a really good strategy when you have what's called a rising interest rate environment. So come on. Well, as soon as this PowerPoint loads, but sorry. I have like a whole training deck on this, but my PowerPoint is freezing up. Okay, so instead of going to PowerPoint, I'll come back to that in a minute. So let's look at Mortgage Coach. So Thomas and Edie Pernancio, okay? We hit preview. So this is a good solution sometimes when you maybe have a customer that's like, I'm not, like they qualify, but they're not willing to make the payment. So that's kind of the situation we have here with Thomas and Edie is they're closing in 4 months. So we were going to do a 6-month rate lock. Well, right now rates are, because they don't have perfect credit, are probably trading closer about 6.125, right? But when we do 6-month rate lock, it pushes the interest rate all the way to 6.95 basically, right? And they're saying they're not comfortable with a $5,600 payment. In fact, they're not even comfortable with a payment at 5,300. I think, Tony, they want a payment, what, at like 4,500, right?
They said 4,000. I'm like,
Jeez.
oh, yeah, you're like
Okay.
way off. Like,
way off, right? Okay. So here's what I would say is I'm going to, just for the sake of fast for Thomas and Edie, just redo this. Okay, so this will be a 6-month lock.
I think we look at that 4-month lock where we lock 90 days and then add point. Like,
yeah, that's
actually, that way we avoid the deposit because it is a big loan. So, it's like a 647 loan amount. So it's like a $6,000 deposit that's not refundable on top of all the points just to get it. So
yeah, it's not okay. Good point. All right, so let's do 830. Okay, and then we're hoping they get their credit score to 720. Yeah.
Right.
Dallas County or whatever. Okay, and then desired lock period 120, but it's not going to populate. It'll probably populate at 90 days, right? And then we add manually. Okay, so we're going to go.
And that way, if it closes sooner, we get the flexibility of like, hey, we don't need to extend a full 30 days. Like it could be 15 days, or whatever the case may be.
Oh, yeah, that's a good idea, actually. Not bad. A good thinking, Tony. Okay, so let's go with. We'll do a 22% down. Let's call this a 4-month lock. And we were quoting them 1.5. Oh, you know what? Yeah, we can remove that long-term rate lock deposit now and maybe, yep. And let's maybe go a little bit higher on discount points because they're way more payment sensitive than they are.
Like 2
1 points. Yeah. Let's do 1.6. And that was 5.95, right? Okay, cool. So we got a 720 FICO. So here's what that's how we would set up the quote, right? To start with is, actually I want to do it this way. Okay. So this is, year 3 through 30. Okay. So this is your starting point. This is an example of a temporary buy down. So I know I'm moving fast. You'll be able to watch this video and slow it down to go a little fast. To kind of think through the logistics of this, but let me just get it set up. Okay. And then we're going to call this year 1. So this would be the first training is kind of like how you would set it up in Mortgage Code. Okay. So here's what I would see is we just priced the loan out, right? With, a 5.95% interest rate, 5.273. 52.73 would be the payment. That's with the taxes
at year 3. Yeah.
For year 3, right? Now cash to close would be 193. This is, I think, new construction, so we're having to charge for Oh, no, we're not.
I
Okay.
didn't charge it because I didn't. Do we have the
We don't know
contract?
yet. We still, they said they sent me the contract, but I haven't seen it, right? So here's the next step is how to set this up in in Encompass. So you go to 10R3, let's see, okay. We go to the ERLA page, the ERLA lender, but let's make sure, let's update the interest rate real fast. So 5.95 for now. There we go. All right, so you go to the ERLA lender page. You scroll down here and where's it? Buydown, right here. Click that button. And so it was a little different in Encompass. So like, we're gonna probably try to make this a seller buydown and have the seller pay for it by raising the sales price, because it's more likely that this property is going to appraise for more, okay? So the cost of the buydown is $14,000, okay? So what I'm gonna do is I'm gonna leave it here at 8:30. Oh, shoot, you know what?
You're gonna have to, if you increase the price, they're gonna have to put more money down.
Yeah, we're gonna run into
That's
that
what
same
happened on
problem.
Mike Tassel.
Yeah,
Which, I mean, they're doing a HELOC, or they would have to do the HELOC.
yeah. So, okay, all right. So then in this case, we're just gonna charge it to the buyer. We're probably gonna exceed our threshold, so we're gonna try to, we probably need to figure out some way to get some seller credits. Which, okay, so I do it as called the temporary buy down charge, right? So there we go. That's the charge. Okay, then, I guess we would need to do it the same thing here. Yeah, it's a little different because I usually do this slightly different because of I normally try to charge this to the seller. So maybe we could find some way to negotiate something with the seller. Otherwise, we might have to cover some of it. Or maybe I can talk the realtor into covering some of it because they're gonna walk away if we don't get this, deal. Oop, don't need to charge them twice for it.
I mean, could they not just put more money? I mean, I don't know.
Putting more money down won't necessarily get their payment that much lower as it will be with the buying down the rate. So like, if you're like, let's
Well,
say, for
yeah,
example,
but
if they put $14,000 down on, like as a bigger down payment, that doesn't necessarily move the payment that much. It
it's
doesn't
just
get
to
them.
offset the increase in sales price. Because yeah, we're gonna run into points and fee issues and like
Yeah, and we're gonna, okay, so this would be what I would say is this is the only way to make the deal work. We're going to, let's see here, $14,000. I bet that's about 200 basis points. So 14,319 divided by the loan amount. So that's 220 plus the 1.6. Oops, sorry.
plus all the other fees.
2.2 plus 1.2. Yeah, we're 3.8. So maybe what we need to do then is go and do 6.49. Gets us, I mean, we're still gonna be over a little bit, but we could do a little bit of a concession and maybe get a little bit of money from the seller and buyer. I mean, because the thing is, we reduce fees if we ever get a seller credit or a broker credit from the realtor. So I could maybe talk to Rachel about giving up a little bit of her money. Let's do 6.49. So then that means the new rate would be 4.49. And this would be 5.49. So what we could do is say, hey, they want to get their payment down in the 4,000 range. I think that could work. I think $100 a month for homeowners insurance is about right. It's gonna be tough to go lower than that, especially at an $830,000 purchase price. So this would be what I would say is like, here's how I would sell it is, so we kind of talked through how I set it up in a mortgage coach. It's much easier to do this if the seller can pay for some of it. We're running into an issue because of the max loan amount, right?
Yeah.
So, but normally I would raise the sales price and get a seller credit to offset that. That way, we can avoid the fee issue. Okay. But this way we would say, hey, here's the thing. If we do a 4-month lock, your payment's about 5,500. Okay, so that's a win over previously what I showed you when you were at 5,600. What I can do is offer you an option where we can give you a payment of 46.89 for the first 12 payments. Okay, so kind of in essence, oh, you know what? This is that's a permanent buy down flyer. Let me show you a temporary buy down flyer. And a flyer. Nope, that is not the right flyer. Here we go. So like this is kind of another flyer. Be first year, second year, third year to term. The remainder of the term is fixed and will not change. Okay. So again, that's kind of some of the points you would go over with the person if they're asking, is saying, hey, a temporary buy down is a 30-year fix. In my opinion, this is better than a 7-year ARM. So like an adjust rate mortgage, like your rate would go up. Like right now, you're guaranteed your rate will never be higher than 6.49. So if you're going to spend money on discount points, I think to a degree, this is maybe slightly better than doing an ARM or spending a ton of money on points. Like, because you get the money kind of back right away in the fact that you get a lower payment. And this is the only real solution I see for a customer that's saying, hey, I'm going to back, like on this client, they said they're going to back out if we can't get their payment into the 4,000 range. So what do we call it? So the other way to kind of sell this is to say, hey, have you ever heard of a student loan? Have you ever heard of an income-based repayment plan, or what's called technically a graduated payment plan? This type of plan has been around forever. Okay, there's been 30 years of graduated payments. They're not that common unless you have a rising interest rate environment. So that's where it's a little more common to see this type of stuff pop up. So what we do is we say this is kind of similar to if someone just got out of school and the school loan people say, hey, you'll take a smaller payment for the first year, and then it goes up, and then the second year it goes up, and then it kicks in for the rest of it. That's kind of what an income-based repayment plan is on student loans, right? We're doing the same concept, but on a mortgage. And so what happens is the actual interest rate, so this is a technical thing that's important if you ever get asked, the actual interest rate that shows in Encompass that we approve the loan on, and the actual interest rate on the closing disclosure, the loan estimate, and all the paperwork is 6.49. We never actually show them a rate on any paperwork saying 4.49. But what happens is this $14,000 buy down goes into an escrow account. Okay. So that gets deposited with us as the loan servicer, and we subsidize the payment. And so like for the first 12 payments, we take that 14,000 and we kick out money and put it into that account for them. Okay. So that's why you're seeing it if you go to Encompass, like this is the escrow account, right? Is that $788 of the payment is covered by us out of the escrow account for the first 12 payments. Then 404. Now this is assuming 5.95, so it's a little bit updated. That's how we got to that figure. Okay. So that gives you kind of an overview of how it works technically, how it give you some talking points when you're talking to someone, how to set it up in Mortgage Coach, and how to set it up in Encompass. Any questions?
No, I didn't know that's how how the fee was done. So that's good to know. Like it's basically like portioned out. So I didn't know that.
Yeah.
So,
because people will ask, it shows on their first payment letter. So a lot of times people will call and kind of freak out on the CD, and they're like, whoa, the rate says 6.49. Don't worry, look at the first payment letter. The first payment letter shows that. And hey, if it doesn't, if there's anything wrong, I promise you it'll be fixed. We're taking the 14,000 and we'll go into an account and we will subsidize the payment. What your actual payment for the first 12 payments will be 2% lower. Okay. And so yeah. And then I would say, kind of just wrapping up the training would be, we can also do, oh, go ahead.
Real quick. So really the buy down is only beneficial to the buyer if the seller is paying for it. Like that's really the best way to do it. Like if they pay for it,
it's Thomas and Edie, the only reason we're doing it is because they say they want a payment at that level and they have money to pay for it.
Yeah. Because normally it's
so
like
Thomas and Edie's not the best example, honestly.
Yeah, it's like I'd rather just keep the 14,000 and like
100%.
I'll just pay the difference out of that 14 my own self. So
they could do it themselves, right? Yeah, they could totally manage this themselves. Like we're just like doing something for them they could do themselves. Like they have enough money. They can't afford this payment at $5,600. They just don't want to. It's a mental thing for them, right? So, but I would say there are certain customers where, like, for example, on Village Homes, what we're doing right now, just so y'all are aware, is we're now talking to them about they wanted me to come up with this program. And so as their preferred lender, I helped them understand how to roll this out because they're very worried. like all builders are right now, that they're going to face a price reduction. They don't want that. So why would Village Homes give 3% in seller credits to allow a buyer to buy down the rate? Because 3% in seller credits on a loan amount is cheaper than giving a 5 or 10% price reduction.
Yeah.
So it costs them less money, and everyone kind of feels a little bit like a win. The buyer feels like they're getting a better deal. Most buyers right now are just freaked out about the payment. They just like it, they're scared. So this is a way to kind of reduce fears. So what we're going to do here, if you for a couple of our Village Homes properties, is they're the seller. So Village Homes, on any of these quotes that come in on this program, is Village Homes is offering 3% in seller credits to buy down the interest rate. So in essence, when I put this rate here, 4.75, what that is that's really a rate of like, I think I actually quoted the rate at like maybe 5.75. And I did 3 discount points, and then I made notes here that we were charging about, I think, 2 discount points to get that as well. So really, if we were ever pricing the loan out, we would quote it with 5 discount points, 3 discount points being paid for by the Village Homes, which would remove it from the ATR QM equation. And I just said rates are effective, as of this date. They're subject to change. So obviously, this is more of a sales component of like, we're just trying, Village Homes just wants to bring in more leads, right?
Yeah.
So if you have a lead come in from, I would say, Wendy, Jones, or Valerie, they're the first 2 to roll this out. If a customer asks about this, this is what they're talking about. And what you would do is probably quote it with 4.5 to 5 discount points, but then you would pull 3 out because that is paid for by the seller, and that will be outlined in the contract. Does that make sense?
Gotcha. Okay.
Does that make, okay.
Yeah.
And that's what's called a permanent buy down. Because in that case, what we're doing is we're literally permanently buying down the rate. Like it is no temporary thing. Like we are literally
We're
going to
just
lock
getting
the
seller
loan.
credits to pay for discount points.
Exactly. Yeah.
Okay.
What is happening is we're going to charge them 5 discount points. We're going to lock the loan with 5 discount points, but 3 are being paid for by the seller. So at the end of the day, the buyer only pays for it, and the buyer can choose to, they could choose to lock with 1 discount point or half. Like it's just whatever it is. The Village Homes is giving 3.
That's
so
nice.
we could show different scenarios, and I got Village Homes to agree that I'm the only lender that gets to offer this. So if you hear of any, like there are 2 other preferred lenders at Village Homes, but I negotiated a deal because I showed them how to do this, where I'm the only one that gets this program. So the buy now, buy down program that Village Homes rolled out, I'm the only lender that gets to do this. So
are they doing that on all properties, or is it just primary?
I believe all properties going forward, not anybody that's already under contract, not anybody that so we have to be a little careful that as of right now, I know for a fact it is applying to Valerie and to Wendy. I don't think they've technically approved it for anybody else yet, but the plan is to roll it out for the entire division. But their divisions. Go ahead.
What about investment properties?
Yeah, we can apply it to anybody. Yeah, investment any
Yeah, I
loan.
know we can. I'm wondering, are they going to be doing that?
I don't know. I haven't heard anything that they're not, because they have a couple people like Ardash Gosu is somebody that bought the property as an investment property. He bought a primary residence and an investment property. We're closing 2 loans for him. No, I think both were investment properties for Ardash.
Both were, actually. Yeah. Too late for him though, but
yeah, too late for him.
But yeah.
And this is also a training I put together on.
So technically, it's not like a 2-1 buy down at that point, right? It's just like, hey, like.
No. The 2-1 buy down is the temporary buy down.
Oh, you're talking about the permanent though.
Permanent buy down is the buy now, buy now program with Village Homes, but could also apply to anybody. Like, for example, I mentioned this to Chris Blackman and Diane about Danny Solomon, because he qualifies. He's just worried about the payment. Like he's anxious, or they're anxious about that payment. So that's why they dropped from a $1,060,000 to a $960,000 purchase price. Well, they dropped the price $100,000. Well, do you think the seller's going to do that? Like,
probably not.
I don't think.
Can you do a buy down on a jumbo?
Yes, you can.
Oh, okay.
So I told them that basically going from $1,060,000 to $960,000 is about a 10% price reduction. I don't know if the seller's going to go for that. So what I told them is, I said, if the seller doesn't go for that, counter back with a 3% seller concession. 3% in seller concessions mathematically is about the same thing as a 10% price reduction. If you buy the interest rate down 1%, That's the equivalent monthly payment wise of getting a 10% price reduction. So like, for example, on a like $500,000 purchase price, if I buy down the interest rate 1%, that saves me about $300 a month. If I take a price reduction of 10%, my savings is about $300 a month. So sometimes you can't get a 10% price reduction. So the thing is, it would be better to take a 3% seller credit to buy down the rate than to just take a 3 to 5% price reduction. You know, you still come out better by buying down the rate if you're in a negotiation with the seller. So that's where, like, what I've done is been sending realtors these videos saying, hey, we call it the seller buy down program. This is the best interest rate strategy in a rising interest rate marketplace where the inventory is increasing. So we did this back in January 2019. We did it back in 2015. Whenever the market shifts, this is a good program. So what we want to tell our realtors is, you want to be an expert. You want to be a true advisor and consultant to your client. You can sell something no one else is selling. Everyone else right now is focused on price reductions. If you're a listing agent, the idea of going to your seller and saying, hey, I did 2 open houses, no one showed up, I think we should lower the price, that is a tough and awkward conversation. But if you say to the seller, hey, we're going to leave the price, we're going to still sell it for $500,000, but we're going to give 3% in seller credits to buy down the rate. For some reason, that is usually an easier pill to swallow for most people. So just something to kind of think about. You might not run into situations necessarily where you have to talk to a realtor about that, but I just want you to be aware of some things I'm talking about. So in my mind, for the last year, we've sold appraisal gap insurance. Then next year going forward, we probably will not sell appraisal gap insurance anymore, because people are not going to do appraisal waivers anymore because it's not so dominant of a seller's market. This next year, it's going to be less of a seller's market. So we're going to start selling this program, and this will be more commonly heard, and appraisal gap insurance will probably not be as common. And we might still have it pop up a few times, but it probably won't be as publicly promoted as it was for the last year. Does that make sense?
Yeah, or I mean, have the seller increase the price and then give a credit, or, you know, to a degree, kind of like they would do, like, you know, when someone needs help on a VA loan and they don't want to pay closing costs.
Exactly, right.
We're like,
and
hey,
I think we'll be able to do more VA and FHA loans in the next year. A lot of times it was tough to get those accepted in the market going back a year. But now I think we could probably be more likely to get some seller credits. And you're exactly right. That's what we used to do on all the VA loans. We just raised the sales price, cover the closing cost.
Yeah. So.
Okay, cool. I'm going to stop recording.